Australia lost 18,600 jobs in April. The unemployment rate climbed to 4.5%, its highest reading since late 2021, and yet the ASX 200 closed up 125 points, delivering its strongest single session in 6 weeks. The two facts sit in the same trading day, and neither cancels the other out. That is the question the session's numbers force open. The morning had already been moving before the Bureau of Statistics released its labor data. ASX 200 futures were tracking Wall Street's overnight rebound, and oil prices had pulled back sharply after U.S. President Donald Trump said Washington was in the final stages of negotiations with Tehran. Brent crude had plunged before recovering to around $106 a barrel, and that retreat was enough to lift sentiment across rate-sensitive sectors. Banks, real estate, and consumer discretionary, the three segments that have borne the heaviest weight from the RBA's 3 rate hikes this year, were already pushing higher by the time the 11:30 a.m. jobs data landed. Then the numbers arrived. Employment fell by 19,000 in April, against economist consensus forecast of a 15,000 gain. The participation rate eased to 66.7%. Full-time employment dropped by 10,700. Part-time fell by 7,900. Commonwealth Bank had already, just the day prior, cut its 2026 GDP growth forecast from 1.9% to 1.6% and upgraded its peak unemployment forecast to 4.6%, citing a difficult trade-off facing the Reserve Bank: inflation still running hot while growth slants beneath it. The RBA had itself forecast unemployment averaging 4.2% across the June quarter. April came in 30 basis points above that. The ASX 200 then accelerated. It finished the day at 8,621, up 1.5%, with 8 of 11 sectors in positive territory. Miners led, with Newmont gaining 2.2% and BHP snapping a 4-day losing streak to rise 3.1%. Banks joined in. Commonwealth Bank added 0.9%, National Australia Bank 2.3%, Westpac 2.2%. Real estate also rose, with Goodman Group 2.8% stronger. The sectors that move most when rate expectations shift, and those are precisely the sectors that have underperformed most heavily this year, were the day's biggest beneficiaries. What the labor data gave the market was not grief. It gave the market permission.
The mechanism is not complicated on its surface. The RBA has raised the cash rate 3 times in 2026, bringing it to 4.35%. And before Thursday's data, money markets were still pricing roughly a 20% probability of a 4th hike at the June meeting. The jobs report collapsed that probability to near zero. IG market strategist Tony Sycamore said the shift reduced the likelihood of further aggressive RBA rate hikes, and that was welcome relief for the ASX, given its heavy weighting toward interest rate-sensitive sectors such as financials, real estate, and consumer discretionary. Markets were not celebrating job losses. They were repricing the path of the cash rate, and those are different things. There is a precedent for this inversion. In 2020, Australian equities rallied sharply on unemployment readings that would have been unfintable in any prior decade, because the deterioration in labor data was being met with unprecedented monetary expansion. The mechanism was the same. Bad data meant easier money, and easier money meant higher equity valuations. The difference today is that the RBA is not easing. It is deciding whether to hike a 4th time. The market is not pricing in rate cuts. It is pricing in a pause. But the detail inside Thursday's jobs number complicates a clean read. Hours worked rose by 15.8 million hours in April, a 0.8% increase, even as the number of people employed fell. BDO chief economist Anders Magnusson noted this directly. An increase in hours worked alongside a fall in employment suggests a nuanced story where the labor market is not cooling as quickly as the headline figures imply. Fewer workers doing more hours is not the same as slack demand for labor. It is more consistent with businesses managing costs by squeezing existing headcount rather than hiring, a pattern that can persist for quarters before it shows up in wage data or consumer spending. If hours worked continue rising while employment falls, the RBA's inflation concern does not disappear, it shifts shape. Commonwealth Bank economists Belinda Allen, Ashwin Clark, and Harry Otley put the central bank's dilemma plainly. Inflation was already running too hot, and will go higher from here, while growth is likely to slow over coming months. Money markets by Thursday evening were fully pricing 1 rate rise by Christmas, a 92% probability, even after removing the June meeting from the table. The equity market celebrated the June reprieve. The bond market is still pointing at November. The question that Thursday's rally leaves open is whether the hours worked signal will matter before the RBA's June meeting on the 16th, or whether one clean unemployment print is enough to hold the board steady regardless.
The 4.5% unemployment print removes the June hike, but it does not resolve the RBA's underlying problem. The central bank's own May forecasts had penciled in 4.2% unemployment for the June quarter. 1 month into that quarter, the actual rate is already 30 basis points above forecast. If the RBA treats this as confirmation that demand is cooling, the path to a hold through the end of 2026 opens. If the RBA treats hours worked as the more reliable signal, the November hike that markets are still pricing remains live, and equities that rallied Thursday on the rate reprieve would face a reassessment. The historical parallel is instructive but imperfect. In 2020, bad labor data and monetary easing moved together in the same direction, making the equity rally mechanically self-reinforcing. In 2026, the RBA is in a different position. It is constrained by inflation from one side and by slowing growth from the other, and the jobs data on Thursday pushed both constraints simultaneously. Lower employment reduces demand pressure, but higher hours worked keeps wages at risk. The last time the RBA navigated a comparable trade-off, sustained inflation with softening employment, was in the early 1990s, and that cycle ended with rates higher than the market anticipated for longer than most forecasters expected. Virgin Australia's 9.3% jump on Thursday adds a separate thread to the same underlying current. The airline has been one of the ASX's worst performers year to date, down 30%, precisely because elevated fuel costs and rising interest rates have compressed its margin assumptions. Thursday's combination of falling oil prices and a reduced rate hike probability gave it back 2 of its 3 major headwinds in a single session, without any new company-specific disclosure. The carrier reaffirmed its FY26 guidance in April, despite fuel costs nearly doubling, and the market had been discounting that guidance. Thursday repriced the probability that the guidance is achievable. That repricing is conditional on both oil staying below $100 per barrel and the RBA holding in June. Both conditions are now linked to the same variable, the next inflation print. The monthly CPI indicator for April is due before the June 16th meeting. If it comes in above the RBA's expectations, particularly if services inflation remains sticky, the hours worked signal in Thursday's jobs data gets more weight, not less, and the June hold consensus begins to fracture. The ASX 200's 1.5% rally was a bet that the unemployment headline would dominate the RBA's deliberations. The CPI release is where that bet gets tested. The more durable version of Thursday's move holds if employment continues to soften, without hours worked accelerating further, a genuine cooling of labor demand rather than a headcount efficiency shift. The fragile version holds only until April CPI. Watch the RBA's language in the days following that release. Any reference to labor market resilience rather than softening signals the June pause is conditional, not settled, and the November hike pricing will start pulling forward. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.